Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, traders and investors, and welcome to this Thursday edition of Benzinga's PreMarket Prep, brought to you by Thinkorswim. I'm Spencer Israel, here with Joel Elconin. I'm sorry, Joel is not here. That was a habit. Joel is still in Florida, but Dennis Dick is here with me this morning. We got a pair of guests on for you today. First off, at 8:15. Pavel Molchanov. He is a Senior Vice President and Equity Research Analyst at Raymond James. And then at 8:35, we're going to be joined by Trip Miller. He's a managing partner at Gulian Capital, a long-short hedge fund. Looking forward to talking to the oil with Pavel and some of Trip's positions with him. But first, we have a few earnings to discuss. Micron, Conagra, a few things still trickling in before the end of the year. And also, I do want to let you know about several really big stories that Benzinga broke yesterday. You may have seen Taser, Twilio, so we'll get to that as well. Dennis, how are you feeling right now?
I'm slowly getting better here,
Okay.
I'll tell you. So my back, I had problems with it for years, but for the last couple of years, my lower back's been really, really good. About 3 days ago, I got out of bed, and in the morning, I was like, oh, my lower back's so stiff. Yesterday, I got out of bed, and it was way stiffer. This morning, I couldn't even get out of bed. I'm sitting there, and I'm like, my back, I can't even straighten it. And I'm sure, this has happened to other people, because I've heard, people within my network, saying the same thing. I guess as you get older, your back can spasm a little bit. I could not get out of bed. I literally crawled from my bed to my office to get here to be able to do the radio show here this morning. So it took me 20 minutes to literally go from my bed to just crawling to my office to get into my chair. It's moving now. My back is moving a bit. It still hurts, but I can move it. Like literally, I could not move it here. So if you guys got a good, muscle relaxer that you guys like out there for anybody who's got a bad back, let me know here right now, because after the show, I think I'm gonna go get one here anyway. So back is giving me all kinds of problems here this morning, although I'm feeling a little bit better right now.
You could say the market has you on your hands and knees.
It did. Yeah. I know it's been a tough, market here, but wow. Yeah, it's
all right.
Anyways.
Literally crawling on your hands and knees to get to your trading desk to trade. That's
how committed I am to you guys.
Dedication right there. All right. Now we're talking about chiropractors in the chat. Wonderful.
Yeah, Canadian whiskey. That's a good one. I like that one.
Whiskey.
I'll go hit the whiskey up, Hoosier. Thank you.
All right. Let's run through some earnings reports before we get to our first guest at 8:15. And start with Micron. They reported yesterday MU Q1. Adjusted EPS 32 cents versus 28 cents. Sales of $3.97 billion versus $3.95 billion estimate. So a beat on the top, beat on the bottom.
Stock was trading down initially on this report. You can see from your pre-market chart there if you take a look at it. And then it got the spike. And it kept spiking and spiking. And it is still spiking here this morning. It's now up 12%. So the run continues here in MU, taking out 21. You got to go way out to the charts here now to try to find resistance here. You got to go back to 2015 when we had a big breakdown day from 25 all the way down to 20. So when I'm looking at this chart, I see a lot of air. Really almost up to the 25 area. Now, usually these stocks aren't going to do it just like that, but I'm just saying if you're, coming in here and saying, okay, well, 12% is ridiculous, there's not a lot of resistance here, though, either. So, we're starting to cut through some levels here. So who knows? Maybe this is something by the end of the year could get up there to challenge that $25 area. But big move here already, 23.05. I don't know if I'm chasing it, but I'm definitely not shorting it. Not right yet.
You see, started the year off at $9. We're up back.
It's been an unbelievable year for Micron, yeah.
Great year.
And now you're talking, we talk about, stocks of the year. Well, you almost 918. You got stock up 150% here in the course of, the 2016. So this is one of your stocks that you could say, hey, this one's been one of the best performers of 2016.
Micron is not semiconductors. What do they do again? I should know this.
I get them all confused here too, Spencer. I don't know how they're all different. There's so many companies.
They are semis. They are a semi.
There's
So
so many semis, but they
yeah.
all these semis do a little bit different stuff. So I don't know. This is where you get a Sean Udall on, and he can tell you all the differences here. I just know this Micron, from a technical perspective. I've traded Micron for 17 years, so it's one of the old ones from the tech bubble
Yeah.
way back in the day. But it does trade technically, and we have a lot of consolidation here, just under $21. Now you get the massive breakout here. So if for whatever reason you get a pullback, I think 21 becomes major support now. But that's 2 points away from here now.
All right, let's
Jamie
move.
from Bright is saying it's memory. He's trying to come in with the save. So semiconductors, and they focus on memory.
Right, right, right. Let's move on to Bed Bath and Beyond BBBY. They did report yesterday as well. Let me get the ticker right. Q3 EPS
Yeah, Joel
8.
always puts double BY, so make sure you put the extra B.
I got
And then
it.
Joel will say, "Oh, they changed it."
I got it. I got
That's
it.
always his excuse
Q.
when he gets a wrong ticker. Oh, they changed it. We're picking on Joel. He's not even here to defend
I'm here to
himself.
defend himself. Q3 EPS 85 cents versus 98. Revenue 2.955 versus 3.01 billion dollars. You see fiscal year 16 at the low end of the 4.50 to $5 range versus the 4.73 estimate. They also report Q3 comps down 1.4%.
Ugly report. Stock got hit pretty hard initially, and then, believe it or not, I think the conference call was on it. Bounced all the way back to flat. So if you look at the after hours action, if you zoom in on that, we cut down to the low 43s. I think actually we might even cut under 43, and then we did get a green candle just briefly, got all the way back up to 45.50, which was at settlement. And then it started to sell off again here. So I mean, the chart's ugly. It's a retailer. Everything's kind of ugly about it, which makes it's the only thing is I think a lot of people were probably bearish at going into the report. And with this report, you'd think, man, it's probably going to get hit pretty hard, but it has held up not bad considering. And you had that low, if you just go back there just from November, that one little low that sticks out like a sore thumb, 43.51. That's the level that it needs to hold, because below there, it is all air.
You don't often see ratings changes leading up to an earnings report, but we did have on Tuesday Cleveland Research downgrading Bed Bath & Beyond to underperform, and Loop Capital initiating at a sell and a $35 price target. So I find whenever you do get ratings changes before a report, I tend to lean that way, just because it's an interesting call. It's a tough thing. It's a tough thing to call, and looks like they both got it right there. All right, Red Hat RHT, they reported yesterday as well.
Yeah,
last
big loser of the day.
Oh yeah, Red Hat reports Q3 EPS 61 cents versus 58 cents. Revenues of 615 versus 618 million dollars. That is whatever. But the Q4 adjusted EPS 61 cents. That's in line. Sales of 614 to 622 million dollars. Estimate was at 637 million dollars. So a big miss on the Q4 sales guidance. As far as fiscal year 17. They see adjusted EPS at 227 versus 222, and the fiscal year 17 sales number came in low as well.
They slammed this stock, and they slammed it hard all the way down to the 68 handle. It has bounced. It's bounced back into the 70, so it's trading at 70 and a quarter, but it's still down 12%. So it's going to be an ugly day for Red Hat. It was trading like crazy last night. Has already traded 28,000 shares here this morning. $70 was kind of the level. If you look just from 2016, you can see a couple lows, one in May and then another one back in July, right at that $70 level. I know it breached in the pre-market, but that's the bogey. It's a big whole psychological number there as well. So that's the number that it needs to hold. Sometimes they like to cut through them by 20, 30, 40 cents, hit a few stops, and then bring it back up. So if we can close above 70, maybe, there's going to be a chance to fish for a bottom here. But it's scary when a stock gets hit this hard. And it's bringing it down other stocks in the sector as well. Citrix Systems is one that trades sometimes very closely with this. I noticed CTXS hasn't traded here this morning yet, but last night was trading down over $2. I noticed VMware was trading down about 50 cents last night. It was even jumping into some of the other stocks as well. I noticed Workday was down, ServiceNow was down. So a number of stocks just trading down here. There's a lot of sympathy plays if you want to look, but I would say if you're looking for for the closest sympathy, I would think maybe Citrix Systems, CTXS, and I think you'll probably be weak on that today with that Red Hat report.
Great. Yeah. Weren't you just saying yesterday though, Dennis, that the sympathy move has not really been a move
It
this year?
hasn't as much. No, it's still there a bit, but it's not been, a lot of these sympathy plays have not been working out nearly as well as they have in the past. And I don't know if that's because they're crowded or what it is, but that's been going on for the last 3 months. Like something like FedEx, UPS, always will have a little bit of a sympathy move. You look at the UPS move yesterday, UPS was down, but not down much. I mean, you're talking about a stock being down a buck, and FedEx was down 7. So
Hmm.
usually your sympathy move is only about a third of what the regular move is, depending on what the stock is in the sector. So basically, if stock falls 3 points, a sympathy move might be a buck. You see a stock like Red Hat falling 7 or 8 points, you think Citrix Systems could fall $2 or $3. But like I said, sympathy hasn't been moving as much lately, so maybe Citrix is only going to fall down $1 or so. We'll have to see. So there still is a move in the general direction. It's just not as pronounced.
Last earnings report that I find notable, at least Conagra this morning, Q2 EPS 49 cents versus 45 cents, revenues of 2.09 billion versus 2.11 billion dollars. So a little bit of a miss on the revs, but a beat on the Q2 EPS. As far as guidance goes, fiscal year 17 EPS buck 65 to buck 70. That's in line with the buck 68 estimate.
Just hanging out here in the pre-market is bid 38.01, closed at $38. So somebody, for 100 shares is saying maybe it goes higher there, but there has been zero trades here today. So still trying to get a feel for whether this one's going up or down, but nobody's hit the 38.01, which makes me think that it wants to go higher.
And then do we care about Rite Aid? I mean,
Give the
does that
numbers. I mean,
matter at
Rite
this
Aid is
point?
all about the merger here now. So if they
Right.
said something about the merger, it would matter. Their individual numbers aren't going to matter as much as, and like we were saying yesterday, it does look like this deal might potentially go through. So even if they massively disappointed, I didn't even look at the Rite Aid report. So I'm just saying, even speculating right now, did they massively disappoint or did they come in line? What they do?
Q3 EPS 2 cents versus 4 cents,
Yeah.
8.1 versus 8.2. So
So they
no.
miss and miss, but it really doesn't matter because the stock is all about the takeover. If it goes out, it goes out at 9. So, and that's what the risk
Yeah.
arbs are doing here. They're giving a little bit of a discount at 8.47 here, obviously a little bit below that takeout price, but significantly above where it was in the beginning of November when they were challenging whether the deal was going to go through. Obviously, risk arbs think it's going to go through here now because they rallied the stock $2 in the last month.
Yep, yep. All right. We have in a couple minutes. We have Trip Miller on the line. He runs Goulian Capital as a hedge fund, and we're going to talk some of his positions. So I want to just do a technical look on a couple of stocks we'll cover with him before we get him on. So let's start with the Win because this is a stock that Trip is long.
Win Resorts because there's
Yep,
two
yep.
wins.
Win Resorts.
WYNN is a stock that has been just hanging out between 89, 90, and 105. You've had this, for if you just go back even to the weeklies there, you can see all year it's pretty much been in a trading range between, on the lower end, it's got down to the lower 80s, the upper end, every time it gets up over $100, 105 seems to find resistance. So, I mean, this is back to the channelingstocks.com thing, when the stock gets to the lower end, around 84, $85, it finds buyers. When it gets up over 100, 103, 104, 105, it seems to find sellers. So we've quickly went from the higher area, 103, and in just 10 trading sessions, we're now approaching the lower area there. So that's something to think about here. We start getting down to 83, $84. I think the buyers come right back in.
And let's do one more before we take a break, and let's look at Berkshire Hathaway.
Stock we haven't looked at for a while, and obviously the value company. It's a very good gauge for value stocks, and obviously value stocks have come back into favor big time since Trump has come in. You've seen some of the stocks with lower multiples, lower growth rates really start to take off there, and Warren's been a direct beneficiary of this. Wow, since Trump has got in, Berkshire Hathaway's went from 145 to 165. So the value stocks are back in favor here, as opposed to some of the more growth stocks like your Facebooks that have not been doing well really since Trump got in.
And Trip owns Class A shares, I should mention,
Oh, the
in
ones that
Berk.
don't trade,
Yeah,
or ones that don't split ever. I
yeah,
don't even like bringing Class A up. It's like $248,000 a share. I
yeah.
always
No,
get scared of
we got to chart
accidentally click it or something and buy it or sell
chart
it.
up right now. Okay, let's take a break and we'll go grab Trip Miller again. Goulian Capital. He is the managing partner, so we'll be right back with Trip.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.
Welcome back, traders and investors. This is Benzinga's Pre-Market Prep, and I'm Spencer Israel, along with Dennis Dick, doing my best to fill in for Joel O'Connor this week as he is off in Florida. We are on the line with Trip Miller, managing partner at Gouin Capital. Trip, how are you doing on this Thursday morning?
I'm great this morning. Thanks so much for having me on.
Thanks so much for coming on. So tell us first a little bit about your fund and what you guys do.
Sure. We here at Gouin Capital Partners are value investors, and we model our portfolio after the way that Warren Buffett originally ran his partnership, the Buffett Partnership. The only difference is that we will do some shorting in our portfolio. So we are value investors looking for great businesses, good to great businesses run by honorable, capable management teams with businesses certainly that we can understand, meaning that we can value them and predict what their cash flows are going to look like maybe for the next 5 to 10 years. And probably the most important thing once we come down to a buy-sell decision is price. And so in a perfect world, we want to pay 60 cents on the dollar or less of our conservative appraisal of what the business is worth. So we spend a lot of time assessing both the business and the people, and we say we've got to have the right mix of the quantitative and qualitative characteristics for us to deploy capital on the long side. On the short side, listeners can probably imagine everything we're looking for on the long side. We're looking for just the opposite on the short side. Poor business models, broken businesses, bad accounting, bad management teams, declining industries. And for us, we're looking for catalysts within 18 months that we think will push the stock price down 20% or more, and therefore we'll short the stock. On the long side, we're willing to own things forever. So, hopefully at a minimum, we get long-term cap gains and own them for at least a year. Our historical turnover has been less than 11% annually. So we tend to own things for a while and not move the furniture around a whole lot.
Trip, just a question here. So when you're holding, and you're saying maybe 18 months for an average short holding period, one thing you probably got to consider is the borrowing fees, because, when you're holding a stock short for that long, especially if they start to become a little more difficult to locate or if they get hard to borrow, can get very expensive in a hurry. Do you monitor those fees, or are you trading or are you just focusing on more liquid stocks to short?
Yeah, a couple of points to clarify. One is when we're looking at a short, we're looking for those catalysts to take place within 18 months or less. Hopefully they're going to occur in the first month that we're short and we get paid and we get out. They don't always work that way. We wish they would. So to your point, yes, we are not tending to deploy capital into what referred to as crowded out shorts. Where everybody else is. We tend to play in the small cap space. Occasionally, we'll go into the large cap area, but it'll be in something that's not, heavily shorted by others. I leave, the Herbalites of the world to Bill Ackman and George Soros and Carl Icahn.
Like, that's what I don't understand. When Bill Ackman holds something like Herbalife, that's got to be expensive to hold that long, just from the short fees that you're going to pay, like from the borrowing perspective.
It certainly is, and that's what gives us a great pause not to play in those games where we don't have time on our side. I mean, obviously on the short side, the best we can do is make 100%. On the long side, we have time on our side. On the short side, the
Right.
clock's working against us. So we are trying to short things that the borrow rate is very, very low. I mean, at the most, a few percentage points, because, over time, that just really eats away at your returns.
Just while we're talking, short, we might as well stick with a couple stocks that you are bearish right now, and one of those stocks is Netflix. Tell us about this. Tell us about Netflix.
I would say that's our most controversial short. We get asked the most questions about it. We have come in and out of Netflix being short twice.
Oh, Trip, you there? Did we lose Trip?
I'm sorry.
Okay, we're still with you.
Spencer, I think we're good.
We're good. All right.
Spencer's mic's acting up. Ignore Spencer. Ignore the background noise, Trip.
I'm just here.
I hear you fine.
No, sure, no worries. Just kind of to reiterate, Netflix is probably our most controversial short. We get asked about it the most. It's right now our smallest short that we have in the portfolio. We'll kind of do a max short of about 3%, and we'll start out at about 0.5% of our portfolio on a short position. So it's very small right now. We're down a little bit on it. Our average short price is about 5% below where the stock is right now. So this is hurting us. Kind of get into the specifics. We're long Amazon. We have been for a very long time, and we've spent a lot of time studying that business, and the byproduct is looking at Netflix. And I see a lot of competition coming up for Netflix. I mean, one of the things we look at when we look at Amazon is they've got such a diversified portfolio with what they're offering to the prime customer now on the video side. While it's not as robust on streaming as what Netflix has, it's growing rapidly. They're investing in that space. And so I think that, kind of as a value investor, the value play as an Amazon customer is I'm getting a lot of what I could be paying for on Netflix for free. Secondarily, the traditional media players that are out there or the other online venues that you can get media from, definitely have Netflix in their sites. So the competition is heating up. We've seen the domestic growth really stagnate over the last 3 or 4 quarters. International growth did finally pick up last quarter, but we think that they're going to continue to have challenges there. And another point that we really focus in on is this content spend. When you look at what they're spending on content, you see a lot of headlines, $5 to $7 billion this year. What they're really on the hook for over the next 36 months is north of $15 billion. And when you look at a business like Netflix that doesn't make money, that's burning cash flow, negative cash flow every quarter, and will do it again next year, we're just not big believers, that businesses like that continue to grow forever. And so I think they've got a lot of headwinds in front of them, especially on the content side where we've seen Disney do so well with this, but, they've made mistakes in the past. And the best players in the world struggle from time to time. We owned DreamWorks, and we learned a lot. We had a successful outcome at DreamWorks. But we learned a lot from studying that business about how hard it is to play in this media space and really pick winners. And Netflix supposedly has this great predictive technology of what we're all going to order next. And so they kind of have an idea, they say, of what type of content to put out there. And while they've had some success with it, I just kind of look at it like if you and I decided we were going to go, build a hamburger stand because people love hamburgers. Well, it's all about the quality of your hamburgers. And we just don't think it's possible to use a baseball analogy to about 1,000 forever.
And Trip,
what were your target? I was going to ask before you change subject. What's your target on a stock like Netflix? Like, are you jumping in this thing looking for a 5-10% move, 15% move, or you're holding on for a little bit longer than that?
Yeah, we kind of look at it, in the short run, thinking 3 to 6 months out, and we think it could test, back below 100. And so that would be a successful outcome for us, and we'd be happy with that. Prior to that, we covered the stock in the 80s on our first outcome, and so we shorted it again leading into its last earnings release and then more afterwards. So even though it's really small for us, we still think that we have conviction in the name and believe that there's more downside potential than upside.
I just wanted to go back to the content thing real quick, Trip. I was reading Netflix does this morning. They have 30 original shows right now, and they intend to double that, next year, which to me seems crazy because there's more scripted television shows right now. I think the number of shows has grown exponentially in the last few years. There's just so much this saturation of content. There's just so much out there, and I mean you mentioned that just now, but I just wanted to get your thoughts on like are they really going to double their content output in 2017? Because they already have a lot of stuff, and the costs of that are through the roof. It's crazy expensive to make a show.
Kevin Spacey's all the cost.
Sure.
I agree. Yeah, I agree with you on all of that. That's a big part of our thesis is that it's not just them doubling their content. There's a lot of really other smart people out there in this space doubling their content or significantly increasing their content. So as I was pointing out earlier, the competition is really growing, and the thought for them to spend all this money on capex while they continue to burn cash. It just doesn't seem like it'll have a very positive outcome for the stock. It's a wonderful business for the consumer. I mean, it was a business that at one point we did utilize, but as Amazon Prime customers and being short the stock, we're no longer supporting it. But I think as you said, I mean, it's really hard to play this content game and be incredibly successful at it over the long run.
Chip, another company, media company on your long list here is Disney, and I just want to get your thoughts here. Why long Disney?
We have actually been long Disney for about 15 years.
Okay, this is just forever holding.
It's a forever holding. We've added to it opportunistically over time. We actually nibbled a bit at it a few months ago, and it's come up a little bit. Bob Iger's just done a fantastic job there. They've got such a wonderful diversified portfolio of assets. They finally have gotten their China theme park online, which is great. They continue to lose money with their European operation there. ESPN for so long had been a huge winner for them. It's stumbled a bit recently. We kind of have a theory that it might be a smart move for them to explore spinning off ESPN. We've seen John Malone be very successful with tracking stocks and spinning things off over the years and creating value for the shareholders. So I know Bob Iger will do that if that's the right thing, but I just kind of wonder, we've seen such a huge spend, sort of like sport content spend at ESPN. Is that really sustainable? When we look at these conference contracts in college sports, the NBA contracts, they're spending a lot of money for eyeballs, and everybody's fighting, whether it's traditional media or online, to get that content to the consumer. And I think that's a very, very difficult business going forward for them. They were in the right place at the right time. They had an incredible run with it, but I don't think the next 10 years for ESPN will be as easy as the last 10 were.
One other stock I see on your long list here, was this a forever holding Apple? Because obviously if you've been holding this one forever, you've been doing pretty well.
No, I was looking yesterday at the news, and it was the anniversary of them buying Next and bringing Steve Jobs back, and I wasn't that smart to have bought it a long, long time ago. But we actually opportunistically, after Steve Jobs was deceased and the stock cratered, we were buying Apple several years ago at less than 5 times adjusted earnings when you netted out the cash.
Yeah.
So we've been a holder of it for several years now. We actually sold half of our position in late 15, somewhere in the high 120s. And we took some interesting feedback from a few of our investors about that, who thought we were crazy to sell any of it. So far, it's been a smart move. We still love the brand and love the business. They're definitely, though, now, more than ever, a one-product business, and that's one of the big reasons we sold half of our position, was just the incredible dependence on the iPhone. They have not had another hit product. Although when you look at the first-year data on the Apple Watch, they actually sold more units in the first year than they did the iPhone in the first year, 2007. So, it's a tougher game for them to. It's now like they have to hit a Grand Slam home run. They've got to hit it 800 feet instead of 400 feet. And it's difficult. But we like what they're doing on the services side. They're diversifying into that, and I think that that's similar to what we see at Amazon, where they're trying to create this network and make that brand a bigger part of your daily life. So we still like what they're doing. Obviously, with all the cash we have optionality on that, potentially with President Trump and the repatriation opportunity, potentially to bring that back at low rates. Maybe they could do some good things with it. But nonetheless, they've been a really good steward by buying back shares when they were cheap and paying us, a fair dividend.
Trip, last question before I let you go. This is from our chat, one of our listeners here. Do you like NVIDIA as a short? I mean, what a year NVIDIA has had.
We have not done a lot of work on that, just kind of high level. We're aware of the business, and anytime that things go on a really big run and they trade at high valuations, it tends to pop up on our screens that we run every day. So unfortunately, we hadn't done enough work on that for me to really have a great opinion, but I do appreciate the question.
Sure, not a problem. Trip Miller, you can check out all his offerings there at Gulen Capital. He is a managing partner. Trip, thank you so much for joining us this morning, and we will talk to you again in the new year. Have a good holiday season.
Thanks so much for your time. Happy holidays.
All right.
Thanks, Trip.
All right, Dennis. Actually, first let's look at balances. It is 8:30, so those.
You like to get that imbalances at 8:30 because it is
I
8:30
do.
right on the button, and those numbers just came out here right now. And you know what? There's some significant ones here too. Bank of America 159,000 to sell. Citigroup 84,000 to sell. Both those stocks are just trading slightly in the green. They're just going to flip red here right now, probably on those imbalance numbers there. Citigroup was 60, 68. They quickly are just looking like it could go down here a little bit on that imbalance data. Just looking, Twitter 83,000 to sell. Man, Twitter. So yesterday we were speculating that, a little bit concerned. I was saying if it took out the low of 1773, well, it not only took that out, it whooshed through it and all the way down to 1708. It is down another 22 cents here. Actually, last night there was a Betaville report, and they've reported some stuff before that said maybe Disney is sniffing around here again. The stock jumped about 10 cents after hours before they realized this was the same Betaville guy that wrote the same article last time and nothing materialized. So they actually turned around and started selling the stock here now. So Twitter's in a whole world of hurt here. I mean, it's in a free fall right now, and you wonder if it isn't going to challenge 16 here in the next day or two.
All right, I want to we have 5 minutes before our next guest. I want to highlight some stories that you may have seen yesterday, and if not, you could have traded either way. So I'm pulling up the Pro right now. This is the Pro news feed. I'm zoomed in a little bit.
Pro had a good day yesterday.
I'm filtering by our most market moving headlines. So going to the bottom here, you can see this at 10 o'clock yesterday morning. This is an 8x8. So we had a source tell us that the board had initiated the process to find a suitor, and no buyers had stepped forward. So I want to go back to the chart real quick. That was yesterday at around 10:03. So let's pull up EGHT and look what happened there. This isn't a yearly chart. Let's pull up a 1 day, 1 minute chart. Right. So this is our headline right here. This is at 10:03 yesterday morning. This was our headline. This was the move that happened, and you can see what happened through the rest of the day. So shares were falling. That spike there is just. I don't know what that is, but clearly.
Well, it's the opening print.
Yeah. So negative headline. You could see what happened there following our headline. Next, I want to go back to the Pro real quick, and I want to show you our headline on so Amazon and Twilio. We had this.
Yeah, this was the big one yesterday, Spencer. This Twilio, this took off here. So what was the headline?
We had a source tell us that Amazon will further expand their relationship with Twilio. I'm reading now directly from the Pro. They'll work together on a voice solution aimed at managing and scaling communications. This was at 11 a.m. yesterday morning. So
that's when the stock starts spiking.
Going back to the chart, let's look at 11 a.m. yesterday. That is right here. That's where my mouse is. So this was our headline. This is before. This is after. You can see the candle right there. The stock starts spiking after that news. Clearly a good headline. They're working with Amazon. Who doesn't want to work with Amazon at this point? So that's what happened yesterday. That's what you could have done in Twilio. And then I want to do one more if I have time, and that is Taser. So going back to the Pro real quick, Taser, we had a spokesperson confirm to us that they won a contract to supply all troopers in the state of Louisiana with body cameras. Anytime this happens, it's usually good for the stock. So it's
usually a buck or two. Usually when you get a new contract with Taser, it usually is worth a buck or two, and that's exactly what it was worth there. You can see the spike right when the Pro came out the news just after 1 o'clock.
Right.
Stock goes from 24 and change, like lower 24s, runs all the way up to high 25s, looks like 25.60. Then it comes back down to 25.01 by the end of the day. But a quick over $1 spike there.
News was at 118 right here. This is our headline. You can see the move that happened after that. So a very good day. I want to give a shout out to the news desk. It was a very, very good day for them.
Bro.
They were all over it, and it was all in Benzinga Pro. If I could do a little shameless plug, I've said my piece, Dennis.
Yeah, we don't shamelessly plug our listeners that often, though. So, I've got my Pro and I keep it up there as well. And I noticed a Twilio. That was the one that I really noticed with you guys.
Yep.
And it took off, man, on that Amazon news. So, nice job, guys.
All
Keep
right.
breaking those headlines.
8:34. Let's take our final break of the day, and we'll go grab one of the better oil analysts on the street. His name is Pavel Molchanov. He is a Senior VP and Equity Research Analyst at Raymond James. He's on CNBC and Bloomberg and Fox pretty frequently, and this guy knows his stuff with regards to energy and oil and solar. So we will be right back talking all that with Pavel.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.
Welcome back to Benzinga's Pre-Market Prep, brought to you by Thinkorswim. I'm Spencer Israel here with Dennis Dick. We're on the line with Pavel Molchanov, Senior Vice President and Equity Research Analyst at Raymond James. Pavel, how are you doing today?
Thanks for having me on.
Thanks for coming on. So let's talk about oil. I mean, what's going on with oil? What's the deal with oil? As Jerry Seinfeld would say.
Well, yeah, I wish we had this conversation 3 weeks ago. Your viewers, maybe would make even more money since then. The OPEC meeting was a pivotal moment. At the end of September, we found out that OPEC is seriously considering doing a coordinated production cut for the first time in 2 years. Actually, in fact, really since the global financial crisis, so close to 8 years. And, we've been waiting for the details, and finally, 2 weeks ago, we got some clarification on, is OPEC serious? Well, they certainly appear to be. They're paying, lip service to it at a minimum, and sometimes that that does the magic for oil prices. OPEC, together with Russia and a few other countries, are promising to cut supply by more than 1.5 million barrels a day. We really doubt that they will fully deliver on all of that. There is a history of cheating here, of course. But even if they deliver half of that amount, that's still very meaningful reduction in supply, about 1% of global supply taken offline. But beyond that, there's the psychology, and this is one of the reasons oil prices have been so strong in the last 2 weeks. Imagine if somebody is looking to short crude, and they know that Saudi Arabia in particular is serious about up the price of crude and actually wants prices to go up, very, very different from the last 2 years. They will probably have. The prices are driven by supply and demand, but they also there is a psychological, a sentiment element to this, and OPEC has certainly done a lot to transform that sentiment to the bullish side.
So, Pavel, where do you see oil going in 2017? Do you think, if they actually do have some cuts in production here, that we might see oil, get out of the 50s, maybe go towards the 60s? Or where's your price target here for oil?
Yeah, at least. So we actually came out at the beginning of this year and said that oil should be in the 60s by the end of 2016, and that was before OPEC ever started talking about doing a production cut. Well, lo and behold, they delivered a production cut, a big one, but oil is still not even at $60. Clearly some other things have come into play. The dollar has been strong because of these high yields. All of a sudden, that's not a good thing for oil prices, so that's a headwind. Certainly production from, a few other countries, Brazil, Russia has been relatively strong. But, all in all, the industry really needs oil at least at $60 to grow supply on a sustainable basis. Let's remember, global oil demand is growing at least 1% a year. In fact, this past year, it's growing about 1.5%. So simply to keep up with the growth in global demand, the industry needs to deliver about 1 million barrels a day of extra supply every single year. And now that's not happening at all. In fact, supply, of course, from just about everybody other than Saudi Arabia was actually down in 2016. U.S., Mexico, et cetera, et cetera. So we think it will be in the 60s and in the foreseeable future, and it might even touch 80, at some point in 2017.
Well, if we get to 80, what oil stocks are you looking at? Because a lot of our listeners like to trade the stocks themselves. Are there any specific companies that are going to be, obviously they're all going to benefit, but who's going to benefit the most?
So the name of the game here is to focus on companies with the most operating leverage to oil recovery. So first of all, stay away from the super defensive names, Exxon, BP. Those are not the ideal way to play the oil recovery. Those stocks were good when oil was falling because they were a safe trade, right?
Yeah.
So now it's kind of the reverse. They're more of a source of fun. So some of the higher beta, more aggressive ideas in E&P. These are, of course, the guys actually producing the commodity. You can look at stocks like Marathon Oil. I really like that one. MRO, that's a mid cap. Hess, that's a HES, that's a large cap. Cosmos, KOS on the small cap side. These are all very, very oily ideas. And there are certainly other derivative plays on oil recovery. You can look at some of the drillers, for example, onshore drillers, especially as prices go up, companies want to invest more capital, which means more rigs getting to work, and that's good for the driller. So the whole value chain should benefit. Look at the pipeline companies, MLPs, but certainly just by definition, the most direct beneficiaries from rising oil prices are the oil producers themselves, which means E&P stocks.
Couple of companies here or a sector that probably gets hit if oil goes up is the airlines, because the airlines have benefited the last few years from weak oil prices. And if you look at some of these airlines, they have just been monster moves. Would you be bearish the airlines then if you're bullish the oil?
Well, you are certainly right that any consumer of fuel is not airlines, trucking, automakers. The higher oil prices are a headwind for all of these guys. But not being an airline expert myself, I'm not sure I would
comment on this.
Yeah, I mean, I probably don't want to get into any individual names there. Yes, it is a headwind for earnings, but look, if oil's 60, 65, in the grand scheme of things, I think they should still do fine. Oil is not going back to 100, to be clear. And even 80, right? If oil may well touch 80 next year. We're not suggesting that oil stays at 80 forever. That would be too high. So ultimately, kind of a sustainable medium-term price for oil, maybe 60 to 70, and that should be a comfortable enough environment for the oil industry, but also not the end of the world for the consumers.
Alternative energy then, if oil starts to get stronger, and obviously maybe that makes alternative energy a little more attractive there as a cheaper source. What are your thoughts here on solar if oil starts to strengthen again?
Well, I always point out to people that solar and wind are electricity sources. They do not compete with oil simply because we do not burn oil in power plants. If we did, that would be different, but we don't. And Europe doesn't burn oil, and China doesn't burn oil. You see a little bit of that maybe in the Middle East. In general, those things compete with coal. They compete with natural gas, and price of natural gas has also been going up. So yeah, there's definitely an opportunity in renewables. It's important to be selective. Many of these are kind of technology companies, and they trade a little bit like tech stocks. So within kind of the clean tech universe, I like and one of these yieldcos. This is 7% yielding stock. 8.3 Energy Partners, CAFD. This is a solar name that operates solar power plants. Again, you get a yield about 7%
Is that
here.
dividend you think safe? Because whenever you
Yeah, oh for
when I
sure.
say 7.5, I'm always scared. Like, whoa, are they going to cut
Well,
that?
it's like, yeah. So this is like an MLP, right? You know, when we think about these pipeline MLPs, a lot of them are yielding 7, 8, 9%. And now this is not technically an MLP. Solar is not allowed to be an MLP. So it's a C corp, but it trades like an MLP by paying these distributions, and they have been increasing them consistently. So yes, it absolutely is safe because all the electricity is contracted. In fact, it's one of the safest way to play solar. You play the company that operates these power plants, and all their electricity is sold at a fixed price for 20 years. It's about as safe as it gets. I also like TPI Composites, TPIC. This is manufacturer of wind turbine components, so kind of a specialty play on the wind market. And they have a lot of interesting opportunities in places like Mexico and Turkey. These are very fast-growing wind markets. And the other one I will mention, this is also a yield stock, Green Plains Partners, GPP. This thing's yielding about 9%, and again, a yield stock that is tied to the U.S. ethanol industry. Now, the cool thing about GPP is they do not actually produce the ethanol. They are attached to a parent company which is producing the ethanol. But GPP simply handles the storage and the shipping. So they do not even care what the price of the commodity is. Price has been going up along with oil. But even if it goes down, it's not a big deal because for GPP, all they care about is the amount of volume. And guess what? More gasoline demand, more cars on the road means more ethanol usage. And right now, if the U.S. ethanol industry were an oil-producing state, it's an amazing statistic, it would be the third biggest oil-producing state behind Texas and North Dakota.
One more stock here, just that I was curious about. If your energy stocks, I'm not sure if you follow the company. First Solar, obviously one of the big solar companies there. It's been stock that has had a rough 2016. Started the year up around $70. It's almost been halved. Actually, it has been halved, down at $33 here. Is this one you follow, and is this one you're interested in?
First, I do follow First Solar. I'm not a big fan of First Solar. The thin film technology that this company manufactures with is difficult. It's they used to have a cost advantage, and now the Chinese crystalline silicon companies have just really overtaken them and kind of been eating their lunch. So I'm not a big fan of First Solar. The stock I mentioned earlier, 8.3 Energy Partners, actually has a relationship with First Solar, but the difference is First Solar manufactures these panels, and they're having trouble competing with the Chinese. 8.3 Energy Partners does not manufacture anything. They simply operate these solar power plants. So First Solar is just inherently more risky, from a competitive standpoint. So that's why I would prefer one over the other.
Pavel Molchanov, he is a Senior Vice President and Equity Research Analyst at Raymond James. Pavel, thank you so much for coming on today. Have a good New Year, and we'll talk to you in 2017.
Thank you. Bye-bye.
That's some good stuff.
Oh, yeah. For sure.
Yeah, I'm sorry.
I was gonna say it's just interesting, when you put it coming out here $80 price target, and you don't hear that too much on the street here. So, or saying it could get up to 80. I guess it wasn't a price target, but he's saying it could get up to as much as $80. So he's bullish oil companies, and I mean it's interesting that he says to stay away from the Exxons and the Chevrons because naturally people think, if oil's gonna go up, I'm gonna buy some Exxon Mobil, but in lower beta, they're not gonna benefit as much as some of these smaller companies that were in trouble when we were down at $20, $30, $40 oil. I mean, Exxon and Chevron were always going to survive down there, so. Obviously they're going to probably go up if we go to $68. It's not going to go up as much as some of these other smaller companies that he mentioned.
I remember his call from last December when he said that oil could hit 70s this year. And he said that just now on the show, of course. But he went on CNBC last December and did say that, and I was like, wow, okay. And lo and behold, I mean, he didn't quite reach it, but but the right sentiment was there.
It was a good year for oil. I mean, after the first 3 months before it got murdered, and then it's come back a long ways from that. What do we get down to? 26, $27 in goldfish memory there.
26.05.
Yeah, 26.05. So really, you think about that, it's pretty much doubled. Since those lows. So, been a decent year for oil, even though we're way below where we were 3 or 4 years ago.
All right, I want to just touch briefly on Weight Watchers.
What's going on here? It's in my filter. It's in
yeah.
my scanners there,
Yeah,
popping up 7%
okay,
here right now. What's up?
Just take a wild guess. Just guess.
Oprah said something.
You're on the right track. 2 ad campaigns featuring Oprah's weight loss have just debuted.
Yes. It's all about Oprah. That's what Weight Watchers is. I mean, $10 has been huge support for this thing. It bounced out of there. It got a lift yesterday starting. Maybe somebody got some wind of this early. Now we're at 11.37 here, so now we're starting to take off. Obviously, Oprah is the one that's kept this company pretty much floating here now, I think. So
Yes.
impressive. I mean, impressive. Like $10 has been support, though, so you can't argue with that 10 support level. I don't know if I want to come up here chasing this thing now. It's been down to 10 so many times. Oprah obviously was the one that hopped on board. If you go back to the weeklies and you really look out back in October of last year when the stock went from $6 up to $26 in 4 days, that was ridiculous. Came back down to earth. It's found a home at 10. It's found major support at 10. That's the level.
Yeah, there you can see right there that gap up. Oh boy, that was a fun move. All right, Dennis, we didn't really cover any analyst ratings today. I didn't see a whole lot that stuck out to me. Anything that stuck out to you in sell side land?
Here's one that does stick out to me, and Twilio obviously took off here. I've been waiting for Sarepta. I've been waiting for somebody to come in here. I said it yesterday on the show that I started to like it here around 30. I still like it here right now, 30.23. JP Morgan coming out, not super bullish, but bullish. Overweight rating here, $40 price target. It's enough to kickstart up. It's up 2.5% here today. Get a close over 30. Maybe some people get interested here now. I like it because it's come back from the area where it was prior to when Outer Pluralson got, official approval here. So give it back all those gains, but have basically since the big run up. So now you're not, chasing it at all. So I like it from that perspective. I'm not close, I don't follow the company very close from a fundamental perspective. I just like it technically here. So, I think, if I was to come in here buying it here today on this JP Morgan initiation and overweight, I'd use a bogey, probably a stop out at yesterday's low of 28.61. So it's just setting you up on a swing trade here. Obviously, if the stock starts to breach that area, starts to make new lows on the move, that's where, I might cut out. But, if this thing you can get around $30 here today, maybe it starts to show some life. Maybe another analyst comes on board here. I kind of like the setup here. That's what I'm saying. I think, it's been down for a long period of time. I think it's time for this trend to reverse here. And maybe this JP Morgan kickstarts it.
Great call, Phil Chen in the chat. Weight Watchers is seasonal. And then Downward Dog, yes. They have a
January Weight Watchers usually.
Downward Dog, yes. If you see Oprah eating at Shake Shack, that is inside information. One more I wanted to note this morning. Tesla, this is a report from The Guardian. Tesla is increasing their UK prices by 5%.
The stock has just been on a run here for really since the entire month of December. Everybody hated it on December the 1st when it got down to $180. And it's been straight up ever since. We got up over 210 yesterday. A little bit of a concerning candle yesterday because it snuck its head above 210 and couldn't hold. And the reason I say that is concerning because back in October we did the same thing. We snuck up, we got up to 213, and then we didn't hold it that day, and we ended up being red on the day. So now we do the same thing, little red candle. It's topped out in the same area, topped out back in October. That is concerning to me. I think he's just got a lot of overhead supply around that 210 area. Stock is trading, just basically flat here this morning. But it's been a pretty impressive run. I feel like if you're coming here now, you're a little late to the party.
I did see a couple of biotech headlines this morning as well. I stay away from that because I don't understand biotech. But let's see. There was a tweet from Adam F. about ALXN. Leerink's analyst is pounding the table on the stock as the big cap buy for 2017. The recent turmoil turning out fine, plus likely activist entry there in ALXN. Whoa, look at that.
I traded it yesterday, and Jeffries, I think, was the one that came out with a note, and they were saying that this could be, I believe do you have the Jeffries note from yesterday? Because I don't want to I'm trying to remember what it was. I was in it yesterday at the open just because of that Jeffries note. It popped up a bit on it, and then, Scalper Blood and me I've already sold, but what was that note yesterday?
No, I don't have it. I mean, they had some data yesterday. They announced top line results for a study did not meet primary endpoint. That was yesterday after the bell.
That what? Yeah, but there was also something I think Jeffries was commenting here on Alexion as well. I thought I saw it go by that they were saying that this could be takeover or this could be a target for a company in 2017. So, and this has been speculation of that before.
Mm-hmm.
So, and I don't follow the company very closely, but a couple positive comments here. It looks like the stock is starting to find some life here. If it can get up over that 120 area, let's close over 120. You start to get in a gap area. You have a gap in the chart from 126.06 all the way down to 121. So if you can get up over 121, you start to have a little more easy sledding up to the 125, 126 area.
All right, let's take a look. At Fred, mentioned in the chat, continued the move yesterday.
A little
A
bit.
little bit.
Inside day, though. It had the big day already. So obviously the stock went from $11 up to 21.77. Inside day yesterday, all that simply means is that the high and the low were inside, obviously, from the day before here. I think you're going to have, a struggle here at that high from that first day at 21.77. But, when the dust settles on these things have these huge pops. Sometimes, they end up, coming back down to earth eventually there. Think about the Sarepta chart. You get the big boom, you get a little bit of follow through afterwards. And then when you look at it 3 months later, the stock's giving a lot of it back. So I'm not chasing it here. And if you look in the pre-market, it's already starting to trade down here, actually. It's got 173,000 shares. It's trading down 7.5% in the pre-market. So I'm not sure if there's a headline driving this or if this is just profit taking here this morning. But Fred's under pressure already here this morning.
Yep. All right. Anything else jump out to you this morning? Because we hit every stock I want to hit.
Yeah, you know what? We've covered my sheet pretty good here. That Overscience, the one that I used to follow here, they had some data come out and it wasn't good. It's down to $2 here now. This was one, this was my stock that I made a lot of money on back if I just go to 2015, late 2014, early 2015,
What's ticker?
when the stock went from 10 to 50.
What's
OVAS.
Okay.
It was one that I followed. They're fertility drugs. They've got 3 potential drugs that they're working on trying to increase fertility, obviously, in women. And, I guess, the data is not looking that promising, and the trials maybe haven't been that promising either here because the stock has went down from $50 down to $297. It's at 208 here this morning. I don't know if this is the one's down 30% here. I'm glad I don't own it here now. I got lucky to get out. On Joel's recommendation, I sold out my last $29. So, and I have not rebought it. So I've been lucky that way. But I just look here at 297 at 210 now. If it got down a low dollar, maybe it's speculative. But this one, it looks like the story's kind of over.
All right. One more Red Hat again for Downward Dog. What was the question again? You asked if they had found support. We covered this earlier.
$70. Yeah, that's the level that I was talking about. 70. It seems to be holding here in the pre-market. That's the level that it needs to hold. That's the bogey. Again, if you're trading Red Hat, I'd look at Citrix Systems, CTXS. It was trading down $2 in sympathy last night. No trades on CTXS here this morning, but wouldn't be surprised to see a little bit of weakness in sympathy with Red Hat.
What about GSAT? Global Star is up this morning. This is a trader circulating reports of a draft order.
What stock is this?
GSAT. Let me get that.
Oh,
right.
GSAT?
Yeah.
No, what's the symbol?
Yeah. GSAT. That's right.
Well, that's not a stock.
I
don't have that.
It is. Okay. Well, Global Star is up. Let me pull up the 1 day, 1 minute chart. Up.
Oh, this is Amex, isn't it?
Is it?
It's not. Yeah.
All right. Well, regardless, a report from a revised draft order circulated by the FCC or to the FCC commissioners last week has picked up votes from the FCC chairman and 2 commissioners of the FCC. So it's getting some support. GSAT is in the Federal Communications Commission and up. I mean, penny stock, but up big this morning regardless. So
where's it trading at?
It's trading at $1.84 right now. Ran a bit up there at 206. So $1.84.
Yeah, been on a run. I mean, this stock had a really horrible June where it went from $3 down to 50 cents or 60 cents. Kind of came back, then it got down in this 50-cent area again. Now it's coming back up here again. Lots of people who got burned up here, and between $2 and $3 are probably going to be looking to ring the register on this. But these things can go for a while. When they start going, they can be funny here. It's going to go look at the short interest quickly. It's 5%, so it's not huge, but very small company here as well. So I always get scared shorting stocks when they're at $1.80 just because they can go up so quickly here. And I mean, if you were shorting this at 50 or 60 cents just a month ago, you're really under pressure here now as the stock's up at $1.80. But this stuff's out of my wheelhouse. These small little dollar stocks.
Short interest, speaking of that, was high and I think remains high on Twilio, I believe. We pointed that out yesterday as well.
Over 30%.
Yeah, lower 30%. So just wanted to, again, throw that on your radar. So that's pretty much it for the day. Looking forward to tomorrow's show, last show of the week. We've got two guests for you again, Chris Brecker of Simpler Trading and Nate Tobick. Nate has not been on for quite a while. He is another really good small bank analyst. So we're looking forward to talking with those guys tomorrow. If you missed any part of our show today, including our chats with Pavel and Trip Miller, you can catch the whole thing again. It's on YouTube, but pretty much right after the show, plus iTunes, SoundCloud, and Stitcher. And yeah, Benzinga Pro, we mentioned on the show today. We had a really good day yesterday on the desk. If you want a free 2-week trial, just go to pro.benzinga.com or also call us up at 313-723-2000. You mention you listen to the show, and there is a discount for you involved. All right, that's it for us today. Please remember that all the information, material, and content from our show is for informational purposes only, not meant to be investing advice. Everyone have a good rest of your day. We'll be back with you tomorrow for our last show of the week.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.